Welcome to The Explainer. Today, we are diving right into a massive showdown in India's absolutely booming electronics sector. We've got two major players, Kaynes and Syrma, going head-to-head. The big question is, who has the real edge in this race to dominate the semiconductor market? Let's dig in.
First off, you have to understand just how massive the opportunity here is. We're talking about India's demand for semiconductors potentially hitting 10% of the entire global market. And that's just in the next 5 years. That's not just a big number. That is a complete game changer.
And of course, the Indian government sees this coming. They are not sitting on the sidelines. To jump on this opportunity, they are launching the India Semiconductor Mission 2.0. And get this, they are injecting a whopping 40,000 crore rupees into the sector.
So, with that kind of government backing, the stage is set for some serious growth. And in this exciting new landscape, two companies are really starting to stand out from the crowd.
Okay, so let's properly introduce our two main contenders. In one corner, we have Kaynes Technology, and in the other corner, we have Syrma SGS Technology.
Now, what's really fascinating here is just how different their game plans are. I mean, both are big, established players. They both make things like printed circuit boards. But Kaynes is making this incredibly bold, direct leap into a really critical part of the semiconductor business called OSAT, which is basically chip packaging. You know, it's that final super important step before a chip is ready to go. Syrma, on the other hand, well, they're playing it a bit safer for now, kind of still exploring how they want to get into the game.
Different strategies are one thing, but hey, what do the numbers say? Let's put these two side by side and check out the financial scorecard.
So if we look at the first half of fiscal year 2026, you can see Kaynes is already way ahead on sales. But honestly, the real story, the one that tells us so much more about their underlying strength, is profitability.
And here it is, the key difference in black and white. Kaynes' operating margin is sitting pretty at 16.5%. That is a huge lead over Syrma's 9.6%. To put it simply, Kaynes is just way better at turning its sales into actual profit, and that gives it this incredibly powerful financial edge.
But, you know, the differences don't just stop with the bottom line. When you break down their entire business models, you see two completely different approaches to the market. Kaynes is betting big on India. I mean, really big. The domestic market is its absolute powerhouse, with exports only making up about 9% of its total revenue.
Syrma, on the other hand, is looking outwards. It has a much stronger international presence. For them, exports are driving a really solid 24% of revenue.
But when we look at the pipeline, future business that's already locked in, Kaynes has a really clear advantage. Its order book is massive. We're talking nearly 9,000 crore rupees. That absolutely dwarfs Syrma's 5,800 crore.
So we've got different strategies, different financials, and very different order books. The big question is, how is the stock market pricing all of this in? What's the valuation story? Okay, first things first. Investors are clearly excited about both of these companies. They're both trading at a really high price to earnings, or PE ratio. This basically means people are willing to pay a premium for their stock, way above the industry average of about 29.
But is that high price actually justified? Well, to get a clearer picture, we can use this really neat metric called the PEG ratio. It's simple. It just takes that PE ratio and divides it by the company's expected growth rate. Now, the rule of thumb is that a PEG ratio below 1 often suggests the price might be reasonable when you factor in its future growth. And this, right here, is where it gets really interesting. Even though both have high stock prices, look at Kaynes' PEG ratio. It's just 0.68. Since that's below 1, it suggests its high price might actually be justified by its incredible growth potential. Syrma's PEG, on the other hand, at 1.88, tells a completely different story. So we've gone through the market, the money, the business models, and the valuation, and all of this leads us to one final big question. So which story do you find more compelling? Is it Kaynes with its super high profit all-in bet on the Indian semiconductor boom? Or is it Syrma with its more cautious, globally focused strategy? The answer isn't just going to decide a winner between these two companies. It could very well end up shaping the entire future of India's electronics industry.